Thank you. Thank you. Okay, so yeah, today, risks, pretty hot topic the last month. Let me do a quick introduction and have everybody introduce themselves. I am Billy Campana. I am the lead dev for Katana Network, the DeFi chain, and all things DeFi. Previously, I worked at API3 for a couple of years, so I kind of know a thing or two about oracles on there, so we can get into the nitty-gritty. We can get a little spicy. I like spice in there, a little Latin flavor. So I'm going to go ahead and start at the end and have you guys introduce yourself, what you do, and where you're from.
Cool. One quick thing, since we're not that many, if you had questions, just raise your hand and we'll make it interactive, optional. I'm Charles from S&P. I'm managing director leading all digital asset across every division. S&P is you might have heard of the S&P 500, the leading index provider, also the leading credit rating agency, and we've got a few other divisions.
Yeah, my name is Carsten Hermann. I'm co-founder and CTO of Particula. We are doing digital asset risk ratings, started with tokenized assets, and now also looking at vaults as a really interesting topic. And of course, oracles are really part of proper risk assessment, I would say.
Yeah, good handoff there. I'm Dillon Hanson. I'm leading the business development team at DIA. DIA is a cross-chain oracle, founded in 2018, live in production since 2020. Currently, DIA supports 61 different blockchain networks. Also, currently a big focus on vaults, real-world assets, and excited to be here as well.
I'm Omer, founder and CEO at Chaos Labs. We're a leading risk and oracle provider, and we are the risk and oracle engine that power applications like Aave, Jupyter, GMX, EtherFi, Layer 0, and more.
Nice, yeah. So we have a solid group here of diverse folks in the space, and obviously it's been not very boring in the last 3-4 weeks in the space on here, especially with oracles and stable coins on here. So the taste for DeFi is pretty low right now. The appetite for risk has been pretty low. We can see it in the market, TVLs dropping here and there, and then the market itself kind of reflecting on that. So, my main goal, again, right here, you guys, Katana, how do I get people interested in DeFi again? How do I get people to trust again? So, when we look at oracles as just one part of the risk, we look at vaults, we look at smart contract risk. How do you get the faith of users to deposit with you or put their money with you? What is your strategy moving forward for oracle assessment, vault assessment? I'll start at the end, and anybody that wants to pick it up right off the top, go for it. Take your time on this one too, because I want to get into the details.
Yeah, sure. Happy to start. So we don't create product, right? So we create on the rating side risk assessment. So there's different angle to it. So first, you were speaking of vaults. We spoke about that just before on the vault angle. There is definitely a need to have risk assessment there. One of the things we did recently was, we created a product for a stablecoin, specifically risk assessment. And we just move it on chain. So I think there's a recognition across, there's two things happening. There's recognition as a risk assessor, like the credit rating agency in general, the old one, the new one, that risk assessment of something that is related to something tokenized or an asset that is on-chain should be on-chain. I mean, it makes a lot of sense. Some people often criticize the fact that the rating can take too much time. But even if the write will not be, real time, well, the read could be, right? So right now, for instance, if you want to check the risk as per S&P of different stablecoin at every transaction in your protocol, you can do that, right? So in the case of a rating, and that's something we could discuss that is interesting, is risk in general. If the risk is automated, like the risk evaluations is automated and it changes all the time, and we saw that in some collapse, right? Hey, you're whatever, a 10 or you're a AAA, and 5 minutes later something happened and now you're B-, and now you're defaulted 1 more minute. It's not super useful. Yeah, it was real time, but you could not really use it. Now, so you need to have this kind of assessment that give you an overall idea of the overall risk that you can use in advance. There could be some more real-time component that make it a bit more interactive, but the looking at the risk and seeing when the change happen could just happen, it could just be at every transaction. So when there is a change in the risk assessment of Particula, of S&P, of anybody else, then you can immediately adapt. And something we discussed also just before is, when you look at the risk, it's not always just to define that, you should not touch this. Many times you want to price the risk, right? You want to know, okay, what is the risk? There's 90% yield. The risk is very high. Well, maybe you still want to use it, but you want this visibility. So that's one of the angles we see. But then when we look at risk also, I'll stop there. It's for who? right? So retail is not interested in risk assessment, like you see the meme coin, you see all the thing, the same way that Wall Street is. And now one of the things that we really see happening is institutional DeFi. We see very big player using Oracle, but using also just DeFi in general, finding out and learning about Oracle risk and all the other type of risk that are there, but still wanting to play. And we have the regulation coming. We have big asset manager looking at things like Vault, and they both need, well, to understand Oracle better, but they also will have this automation themselves, this interest in getting risk assessment that can be embedded in their model, leveraging what they have in TradFi and more automated solutions.
Yeah, so this was a very great start, Charles. Thanks for that. And picking up on this, I think also because you asked, like, what is actually enabling the whole space to really get, again, more and more involved despite all the risks, despite what's happened. And I'm just coming from the Vault Summit. We have also been on a panel there together. And what comes out very clearly is that oracles are actually like the biggest enabler when it comes to those financial products. And from our side in particular, of course, we want to create this trust and transparency layer. So for users, it's actually possible to evaluate all the risks, but also opportunities which are connected with the DeFi product, for example, a vault. So we want to really bring up this transparency, make it clear which roles do we have within this vault setup, what's also like maybe the counterparty risk, because everyone always thinks only about on-chain risk, but that's not the only thing. Also like the underlying asset risk, I think especially something where S&P comes into play again. And you know, in the end, it's a combination, and we really need to create this 360-degree overview. So our strategy for this are two things. On the one side, it's like we call it a risk passport, which is completely on-chain, can be consumed by any kind of protocol, and it can be, or it is highly dynamic, of course, and it's also very good, what you mentioned, Charles. Like, we're living in a very fast-paced environment in the blockchain space, but we still have to consider that actually it's a DeFi product, but the underlying asset is not as fast and sophisticated. So if I see there's a redemption time on the same day, like T0, what's actually the redemption time of the underlying asset? 2, 3, 4 days. So how does this risk really come up in the end? And to make this understandable, but also to understand the difference between NAV and shadow NAV. So is the NAV maybe tied to a fixed value coming out of that? But is it not really related to the actual market value? And to really create this understanding in the mind of the user, I think this is key, and that's why I'm talking about the risk passport. So how can an asset become eligible to be used in the DeFi space? And the next thing also to create this understanding, and it's also something that was just mentioned here, it's not about completely reducing and taking out all the risk and only focus on this product. It's about understanding it, and also which opportunities do I have to create some really nice yield and return. So we are just coming up in this moment with a structured yield index, which makes it possible across asset classes of tokenized assets to understand the risk profile and the yield profile. And with that, we can really create transparency. And also then for the user, it's much better understandable because of the mix of assets in the pool or in the vault. Why is the vault rated as a certain score? And then we also have components like governance structure, as mentioned, counterparty risk, the legal setup, compliance setup. So could it be that we have the situation that the vault consists of assets which are highly regulated, but the vault itself, with its mechanics, is not regulated yet. So what are the possible consequences of that? And that's why I always tell when friends ask me, hey, where should I invest into? I don't say any names, I just say, invest only in strategies and assets you really understand. And I think that's the biggest problem what happened in the past couple of years. People were only looking at the APY and were seeing like, oh yeah, okay, this looks really amazing. It's like 20, 30, 30%, not considering there might be just like token incentives part of this APY. So where's the APY really coming from, and how sustainable is it? Do I really understand that as an investor? I hope you guys understood me already in the minutes before, because I just noticed the microphone was a little bit too far away. Yeah? All right, thanks.
So yeah, I would completely work off of that and address this again from transparency of, as you described it, like kind of the DeFi risk stack, right? This goes deeper than just the relative risk of a certain asset or the volatility of the underlying assets included in a vault strategy, but it's really deeper than that. It's what is the oracle you're using? What are the dependencies of that oracle? On which RPCs does that oracle depend? On which message passing protocol or bridging framework does that oracle?
And incentive.
in the incentive. Right, exactly. And so from our end at DIA, from the Oracle side, it's really our ethos that the Oracle itself should be a truly transparent data provider. That we're really trying to escape the idea that oracles can get away with trust assumptions regarding data provenance or regarding where a data is being sourced, even down into the individual pool or the pools that are being used to actually generate and create a price feed. So within the DIA architecture, kind of like summarize how this works is we actually scrape data, and this is a bit about like a little differentiation between DIA and most Oracle architectures, is that we scrape data directly from the first party markets themselves, directly from the DEXs and the centralized exchanges, as opposed to leveraging off-chain third-party data aggregators. And by going directly to the source, the architecture enables a fully transparent data pipeline. Again, mentioning even down to the individual pools from where data or markets on a SEX where data is being sourced, all the way through a decentralized set of node operators and an open source smart contract system into how the data feed is actually being pushed into the destination chain smart contract. And so in doing so, it actually enables an architecture that users can audit end to end themselves. We're really trying to get away from this idea of trust assumptions and opacity within oracles. That's our ethos. And again, I want to take a step back and say I think it goes deeper than just oracles as well. It's again these unique dependencies that even oracles have on the underlying RPCs or the underlying message passing frameworks that they're leveraging. And it's like, and I'll bounce it back to you, Carsten, once we go around, but within do we get to a point where we have one standard risk rating that accounts for all of these dependencies, all of these risk factors, or are they analyzed separately? And from my end, I think, sure, with very educated, advanced fund managers or vault curators, and advanced investors, they might be able to understand those risks, read through all the Dune dashboards, break this all down, and really analyze it. But for the uneducated average investor, where do we land? That's the question I think is fascinating. Is possible to arrive at a singular risk rating that factors in all of these different levers of risk?
Really, really good points, and I think a few different vantage points here on the panel so far. At Chaos, we sit at a different part of the stack. So first of all, one of the things that have been really instrumental to help, let's say, increasing the threshold and the reliability of all the applications that we serve is understanding that, first of all, risk is a stack in itself. So there's no silver bullet. There's no single kind of piece of software protocol which can protect you across all the risks. When we look at risk, we look at it holistically. So there's market risk, liquidity risk, governance risk, smart contract risk. Of course, there's Oracle risk. And as we've seen in the last few weeks, counterparty risk is huge. So it's important to build frameworks, but at the end, we have an explosion of kind of tokenized assets. We've gone from 0 to 350 billion over the past few years. I think the belief of everyone here on the panel and the summit is it's soon going to be several trillion. And all these asset issuers are issuing assets in different jurisdictions. They have different underlyings, different backing assets. So it's really first realizing that we're going to need many, many risk frameworks. So in terms of having one risk score, I think it depends who are we kind of providing the score for. For retail, it's not realistic that they're going to understand everything that we're speaking about here on the panel. So perhaps having one score which encompasses it is a good idea. But for the more sophisticated investors and the applications themselves, it needs to be very, very clear what the trade-offs are. And this isn't only in the risk score itself, it actually goes into how you price the assets, right? So one of our tenets is that every oracle is effectively a risk oracle. The manner in which you decide to price an asset is going to have significant downstream effects on liquidations, P&L, and the overall security of the position. And a great example of that is October 10th. Right? We really saw the full spectrum of Oracle prices, which were hard-coded, Oracle prices that went direct to source, even used the most liquid venues. For USDE, in that case, was Binance, but completely depegged and didn't have any other kind of guardrails in place. So the surface is really huge, and it really needs to be customized, not only to the type of assets that we're speaking about, but also to the type of application. So for example, one of the things that we really work on is we have different oracles for lending markets than we would for a high leverage, low frequency perp dex, right? And in a lending market where you have massive billion-dollar positions, or for example, in Aave, which we manage, there's 40 billion there. What you don't want to do is liquidate, 5 billion on Ethereum mainnet because there's a single wick that lasts 30 seconds, right? Especially if it's a tokenized asset and you know at any given moment that the asset can be redeemed, right? There's no issue with the redemption queue. The liquidity is good. There's just a faulty data source. And this is a very different set of considerations than a perp dex, right? Where you actually need that low latency and fast updates. So I think this is a long way of saying there's no one size fits all. For everything that's been said so far in the panel, there's a place, but we'll need all of the things. It's not mutually exclusive.
Go ahead.
Yeah, so I just want to touch base on something you said because I think that's highly valid. So at the moment, we see many risk curators, risk providers, etc., focus a lot on like the on-chain activity and especially on like liquidation risk. And in general, and I think that's exactly what you mentioned, what we are now seeing, and we currently internally do this based on yield-bearing stablecoins, is really to abstract this liquidation risk towards more like a counterparty risk. Because just thinking about, we have now like a lending pool where we use tokenized assets as collateral. And let's say like the yield I can make from the collateral might be, let's say like 5%. And the interest rate to borrow the money might be 3%. There is no real material risk that it will be like redeemed anytime soon. So there's no reason for this. There's no motivation. But what we are looking at now is what's actually the counterparty risk from or towards the issuer of the tokenized asset in the pool. Like, is the issuer going bankrupt? What kind of strategy do they have in place? What kind of legal setup do they have? And also like the product that has been tokenized. So therefore, the risk is completely shifting away. And I think that's a point many people do miss right now. While, of course, vaults consisting of like tokenized assets are of course, like increasing stability, etc., reducing the risk as such, we also need to have this 360-degree perspective. And therefore, I would also agree to what you said and also your question, Dillon. There is not like one size fits all. It's always a combination. I think it's also great for this reason that we also have like a traditional player on stage here, because we also need to understand what's the actual risk of the underlying asset. We are then tokenizing, we then put into a vault, and maybe then we even use this in like a fund of fund structure of another vault. So the risk is layering up, and we really need to go very, very deep to understand it. And I think that's a really big challenge, to have the users understand it. So I think this needs a lot of, maybe not training, but yeah, a lot of explanation, and also really showing this kind of case studies where we see what happens if this is not addressed properly.
Those are really good topics. What I'm getting at, like with the different risk levels, is really the Oracle is kind of like the base source. You can have perfect code, everything audited, but the Oracle can just mess you up. So being that it's one of the most sourced, bottom layer of like the security of it, where do you think the responsibility is on the Oracle to list assets? Right? Like I get requests all the time at API 3, hey, can you list this? Like, no, wait, does it meet liquidity standards, or does it meet, vault return standards or anything, or a redemption rate takes 4 days. There's no way that price is going to stay the same 4 days. So at what point do you expect the Oracle to kind of like curate the curators in a sense on there? Like what is your opinion on that? Because it's a very interesting topic. Like if someone doesn't list it here, someone else might. Maybe they have that higher taste for risk on there, a more responsibility. So like, what is your opinion on that? Like, should the Oracles be like, no, until it hits requirements? Or you want to move some markets, you want to make some money, and you want to be the only market that takes it, right? So your risk-reward ratio. But what do you feel the Oracle responsibilities are, in a sense? Anybody can take this one. This is.
I mean, we have an Oracle provider here, so I'm really curious to see.
Put you on the spot. Yeah.
Go ahead. I think, speaking, I guess, on behalf of our QA team, I think it's important to be rigid. We don't ever skew from the criteria, the liquidity and volume and source criteria that we have in order to support a data feed. So it's a great question, though, and I think the question also that's interesting here is like, where does the responsibility lie between the risk curator and the Oracle? But from our end, yeah, it's always a process of first being rigid for quality assurance, because ultimately this is the solution that we're providing. We are the ultimate end factor of who's providing this the risk respective to a given asset. So that's pretty much it. There's other areas I would love to skew into, but I'll keep it at that for now. Because maybe one thing I will say, we might go there, but we're also, I think there's an also new exciting topic or like kind of semi way of pricing assets that get outside of just volume and liquidity criteria. With net asset value backed price feeds and other fundamental valuation of price feeds. And so from the Oracle's perspective, we're seeing like more opportunity for flexibility outside of these parameters when cases apply, when there's a stable coin or a CDP that has a ton of reserve backing or a ton of collateral, either on-chain or off-chain reserves that are backing the value of that asset. You can kind of get away from just this rigid liquidity and volume criteria for a market-based price feed and actually price assets based on the underlying net asset value that's supporting them. So I think it ultimately lands on the responsibility of the Oracle to be rigid there. What I wanted to share there is that there is new exciting opportunities that we're seeing to get outside of that rigid criteria.
Yeah, just to add to that, I agree with everything here, and really from a market perspective, I think today what Chaos provides is risk oracles, price oracles, and proof of reserve oracles. It's really neat to kind of think about these things as distinct offerings, but really everything is a risk oracle, right? Like we said, the way that you price the asset dictates the terms of the loan, of the trade, the liquidation, and more. So the approach that we've taken is you want to integrate all of the valid, high integrity data sources that you have. A good example of this is the work now that we're doing with Aave. So we have a proof of reserve system, and this should exist for any asset that's being tokenized, because effectively you have a problem here where you have two parallel systems that are running in tandem. Each of them have their own assumptions, security, and risk vectors, and you need them to run in sync, right? So an example of a hybrid pricing methodology is we understand what's happening on the secondary markets in terms of the volume and the liquidity and centralized exchanges. That's great. But again, if you're using this asset and you need to price it as collateral in a lending market, what you care about fundamentally is your ability to redeem this at one-to-one parity, right? And if the asset issuer is transparent, so we work with Athena, we work with AUSD. AUSD, for example, we integrate with State Street, their custodian, to provide a stream of attestations that the reserves are always more than the minted supply. And if you're having this in real time, then the secondary market liquidity can be a different indicator that you can fall back to if these attestations are no longer coming through, right? And this makes the system more robust. On October 10th, and also unfortunately this weekend, billions in market liquidity were vaporized on all of these small wicks that were happening on distinct venues. And the way to move away from that, the way to get to more robust pricing is integrating everything. Going off-chain and integrating with these off-chain systems is increasingly more important. And as Charles mentioned earlier, it needs to be dynamic and it needs to be in line not only with the vault manager, but also the underlying protocol. Because one concern here that can basically be materialized is that, okay, the vault curators are extremely diligent, they're responsible, they're using all the ratings that exist and how to price these assets, but the underlying protocol is not using it, or maybe thinking about those risks differently. And here there's a divergence, and the end result is the same. Users get hurt. So, I mean, we have the kind of privilege of being in the most transparent, open source, data-rich environment that there's ever been for finance. We need to use it. And using kind of what I call more legacy methodologies for pricing assets, like medians from exchanges or only relying on what's happening in secondary market liquidity, it works well for Bitcoin, for Ethereum, for Solana, these assets that have good markets most of the time, but not always. And even for those assets, I'll just end on this. There was massive price divergence on October 10th on assets like Bitcoin and Solana and Ethereum. We saw wicks and price dislocations that were up to 20, 30%. So we need to get better. But I think we are as an industry. It's just growing pains.
Yeah, many great points also to continue, but let me pick only two of that. So one is, I think in general, we also need to differentiate between like the actual NAV that's coming out of an Oracle and what we call like the shadow NAV. So what's the actual real market price? Because typically the NAV, and we saw it several times on issue website, etc., is just like a static number. So this is not really the market value, not the market price. And I think this really adds up, especially when we have this kind of really layered mechanics within vault structures, etc. And therefore, I think, and this becomes really, really difficult to what you just mentioned. Just imagine you have like a tokenized real estate property. And there's like, it's located, I don't know, somewhere in the world, there's a storm, there's like environmental risk, whatever is involved. There's only a paper value. And this is being used maybe also to borrow against. So there you can see the combination of like on-chain pricing mechanics, on-chain pricing history, etc., but also including this off-chain world, because like you mentioned, we're tokenizing real assets that are residing in the physical world. I think this is really important and really difficult in some cases to do. So there's still some work. But for me, it really starts for also the understanding for the users to differentiate between NAV and shadow NAV, to understand that what I'm seeing here, this number, might be not the realistic value of this asset.
I think the whole conversation has been very interesting, but also niche, looking really at the pricing oracle. And as we touch on RWA and the oracle I'm looking at or thinking about, they're different, right? So for instance, just saying that the oracle world is bigger than that, in the sense that I got banks coming to me and saying, hey, we want to do a tokenized green bond and we want to have some of your data on chain so that the green bond could use that directly, right? It can be related to carbon credit, could be related to a lot of stuff. So it's kind of different world, right? Here, it's like there's a single source of truth. You just want to have the data there. And then when we start to get to the conversation of, well, in that context, who is the one that should look at the risk? Is that the curator? Is that the oracle? I think, well, there'll be a different look at it when we look at the RWA and these kind of things, where the role of the oracle will really be to, well, help bring the data from off-chain to on-chain and the interoperability that goes with it, etc. Well, once the data is on-chain and you can trust that it is accurate, then you'll have, the creator use it the way they want. Something that, and I understand how, like we needed the price of Bitcoin somehow on chain. It was not there, so that's really how it started. But it's also, and I'm not pointing at anybody, but a lot of solutions seems to be really made with that angle from the start, right? So for instance, when I speak with some oracle and they tell me, hey, you could have your rating on chain. And so the way it works is, will you set up an API and then we'll explode this data to 1,000 node, and the 1,000 node will all agree that what you said is what you said, and then they'll tell people that's what you said. It makes sense for pricing, where you could have, there's Binances everywhere, but it's really hard to explain to Wall Street why it makes sense when you're the single source of truth. I need 1,000 people to confirm that. So I think there's this angle. Then there's all the there's a lot of just trying. We don't have to explore that. I think there's a lot of interest also around privacy. For pricing, again, it might be different, but then there's a lot of data that you might want to have on chain, but not everybody to see. I got a lot of examples like this. So, for instance, for years, I had some of the most famous oracle coming and say, well, why did you put your data on chain? Yeah, okay, well, that's great for you. What, do you have a use case? No, but you could make 40K a year. And but the thing is, some people will pay a subscription to get access to some specific data. You put it on chain, you can access it for $0.01. You're cannibalizing your own business. So that's where the emergence of ZK and other type of privacy for like data on chain gets really interesting, because if it's just putting the data on chain, some internal tech team will say, oh, we can do it, we don't need an oracle. But if we start to add the added layer of like new stack of technology, I think there's going to be a lot of interest here. So we can stay on the pricing angle, but I'm interested in that one.
Yeah, maybe not the pricing angle in particular, but it's always a funny joke in particular, because we are like Particula. I really like that one. Because your original question was also, how can like an oracle provider really ensure also the quality? I think it starts with like having multiple sources for data and for price, but also maybe other data like NAV, proof of reserve, etc., where it becomes really, really difficult to have multiple sources, but then also to do like deviation checks and have some circuit breakers. I think the circuit breakers might be more to be included in the mechanics of like a vault or a DeFi product when they have different oracles in place. But also for the oracle provider itself, I think it's a big opportunity. And it's also what you mentioned regarding like spikes, which are only short term, to really benchmark it against the general market behavior. What do we see with assets from the same asset class? Do they also spike in the same manner? How long is it going? To also have like a little timing component into it to really see, is this like a sustainable development or just a spike that's lasting for a couple of minutes, in order to avoid to start this kind of cascade, which is starting when the oracle is emitting wrong information, then the protocol picks up on it, then the users are acting on it, we have automated liquidations, etc. So I think there's a high responsibility on the oracle side, but on the other side, the oracle is providing data, and the responsibility to ingest and also maybe assess, evaluate, benchmark this data lies also with the DeFi protocol to protect users from it.
I think this is great. There's a few points. So kill switch oracles and circuit breakers, they actually exist today. So for example, on Aave and Jupiter, on GMX, EtherFi, all these applications we work with, these are exactly the things that are already live in production, right? So when anomaly is occurring and there's uncertainty in the system because we need more data in order to understand what the state is, it freezes, right? We've already seen this in production. So this is like table stakes, exists in traditional finance. It's now being integrated more. What it requires, however, is understanding the underlying mechanism, right? So deviation checks are a really simple example that everyone can integrate today. There are other things which are more related to the business logic of the restaking network, the lending market, the perp decks, which are more particular. Now, some of the other things, one of the fallacies I think that really exists that Charles touched upon is that more nodes equals more security, right? And I think time and time again, we see that it's not the case. And we don't need to go too far. I think it was last week, there was liquidations on Moonwell that were, I think, to the order of magnitude of about 5 million, using a market rate oracle to price Ethereum, which ended up pricing it at 5 million and liquidating all these positions. Now, if you actually looked on chain at the oracle that was being used in the price report that every node provided, you had many nodes providing the same exact price of 5 million. What does that mean in practice? You have all these decentralized nodes, wonderful. They're all using the same third-party data aggregator, right? So there's a few issues with that. What's the point of this decentralization if we're all using the same data source? You could argue maybe reliability, but I don't think you need 1,000 nodes for that. You could do with less. And the second is, do these node operators even understand the differences between the data that they're providing? So I think historically, one of the positions that many big Oracle protocols took, they said, we have no opinion on the data. We're a reliable infrastructure. We'll put the price of Bitcoin on chain for you. Behind the scenes, we're working with 3 different data providers. If there's an issue with the price, speak to them, right? But today, where the industry has gone is that we're settling trillions in volume. And I think we can't really take that position anymore because it's this exact price that's responsible for the loss of funds. So kind of going back to where you started from, where does the responsibility lie? I think you need to understand what the consequences are of doing this wrong. Do all the diligence that you can in order to create something that's robust. And if you don't have the confidence that this is robust and that it's frail and that it has a single point of failure that can easily flip, don't provide it, right? But I just want to say that, like, I don't think it's, very honest to the end users where we put forward these type of oracles that are one size fits all, and then to alleviate ourselves of any responsibility in times where you actually need the oracle to serve as a source of truth, because that's when it really matters, right? Not like when everything is dandy.
Right.
Just one,
Also comment from the actual oracle provider.
One addition onto that, right, is this idea that it shouldn't be one size fits all. It's not. And so the question then I'd like to pose, and what I find interesting is like the idea of then, okay, there's a particular risk rating associated with a specific Oracle feed. And as you mentioned earlier, it's like the closer you can get to full transparency, down to the individual pools, the volume, the liquidity, the sources that are being used to create a price feed, the better understanding you can have of the amount of capital it would take to manipulate that pool or to manipulate that price feed. And thus on the the output side, that could maybe that makes then a better risk analysis of how much capital this feed should be securing uniquely. And so maybe that is, and this is something that kind of we've been ideating on for a while. It's like, could there be a specific risk rating that actually shows down through the whole transparent pipeline how much capital can be secured by an individual oracle, in a way where like the result of exploiting that pool or manipulating that, the cost of actual manipulation is higher than what you'll actually be able to get out of that. So you're not securing a price feed, or you're not securing a vault or a pool or a market rather, where the cost of manipulating that out is higher than the amount of capital you can actually exploit from that pool.
This is great. It's like one of the fundamental tenets of an oracle, right? And this is how we think about when we design our oracle pricing methodology. What you need is that the cost of corruption to be much, much larger than the payoff. This isn't only like a theoretical thing that you'll see in a paper, because today we actually have nation state actors who are well capitalized, who will kind of, if it can be exploited for cheap and the payoff is large, they will do it. And we've seen it before. One of the funny stories was, I don't know if anyone remembers the CRV short attack that was attempted on Aave several years ago. And whoever's familiar with Avi Eisenberg, the famous Mango exploiter. So we actually had him in our DMs asking us, what do you think the capital requirements are for moving the price here, right? So this is one of the things that, like, if you actually think about it from a different angle, you need to be careful. Because if you have an accurate model that at any given moment can make it in a very transparent way, price the required capital to move a market, that is just a roadmap for an attacker. It says, oh, cool, 70 million. There's 50 billion in Aave. Sounds pretty reasonable. We'll do it, right? So definitely you need to take into consideration the depth of the markets, and this kind of connects to what you said about shadow NAV, right? So shadow NAV is one thing, but also shadow pricing, right? The price of this asset is $1 million, but there's only 10K liquidity, right? So what is the actual price? All of these things come together. Market manipulation is one of them, but there's so many different vectors. And this was like the example of stream collapsing in XUSD. This is where kind of integrating with the off-chain system comes into play. Even if you were connected to every single venue for this asset and its price on every market, you wouldn't be able to know because it was just completely opaque. And their downfall was, we're going to see the postmortem, something that happened off-chain and likely a directional trade that they took. So it's really a taxonomy. It's a really big responsibility. There's a lot that goes into it, but it's something that we need to solve if we're going to mature as an industry.
100%. Like, yeah, I'm going to kind of bring it back to the oracles because I know it's really hot right now. Real world assets, right? We're tokenizing everything. And way back when I was playing with the bar of gold theory, right? It was just me, loading something on an API, single API. Yeah, it's good. Trust me, right? And creating a feed. I'm like, well, how do I verify this piece of gold is actually there once I tokenize it, right? When I come to have my tokens, I'm trading it. I won big, and I come to collect. Is that physical bar of gold actually there, right? And then we have this single source of truth, right? Because who else is monitoring it? Price feeds, we can see it everywhere. We can see it on DEXs, centralized exchanges. The data is everywhere. But when we're looking at physical assets and we tokenize these things, how do we actually prove it's there other than the actual source of people telling us, yeah, it's really here? I wanted to see what your take is, your risk analysis on that, like how you guys handle that kind of ideology.
Yeah, I think it's an increasing factor, especially as we see bigger diversity also in the asset classes that are being tokenized. Maybe also talking about the example you mentioned with gold. Of course, I need to have like a licensed custodian in place who I can really trust, who is not like on the market since yesterday. Maybe some track record. I think for gold, we have like Brinks in place, for example. And also one thing, and it's really interesting because you already mentioned earlier, like environmental assets. And before doing like Particula with the risk ratings, like I think 5-6 years ago, I was like in the space of like tokenizing carbon credits. And this was already the problem back then, and it's still not solved. But you can see, for example, with Ant Technologies in China, who are currently really tokenizing like windmills, etc., solar panels in a really big scale, that the use of IoT becomes really crucial in that matter. So like a sensor which is confirming the availability of the physical asset, the amount, the condition maybe even, and also what is producing. So for windmills, it's highly interesting because you can directly measure using the IoT sensor with the windmill, you can directly measure how many energy is being created, where is it flying to, what's the market price, how many carbon credits can be created based on this, et cetera, et cetera. So we create this really kind of sophisticated data stream. But now think about real estate, precious metals, et cetera, financial products. So it's a big, maybe not problem, but challenge to solve. Definitely, I think lots of opportunity also for Oracle providers. But this whole point of proof of reserve is one thing, but it's also what I mentioned earlier, the time to redeem it in the physical world, to actually really transfer my piece of a certain building or of a windmill or whatever. This is a completely different topic, and I think the possibilities of tokenization are like huge, and it will not stop to increase and grow in the upcoming years. But the tech is really this big enabler, and also then standardized frameworks. Not only risk frameworks, also economical frameworks, governance frameworks, etc. So there, I think, lots of room for improvement and lots of opportunities on the market.
I think a lot of the risks that we'll discuss here today are among the risks that are the less understood by big institutions. I spoke recently with a lot of insurance companies, and they got a lot of interest, a lot of work related, for instance, slashing risk. And that's because, well, they got requests for that extra. But even them kind of, we touch on many of the risks that I thought they should be product around extra. And the consequence of this is, because I'm interested more, like on personal side, I'm very interested in DeFi, all that. On the professional side, I'm more interested in an institution coming in and leveraging the technology and bringing the trillions on chain. And well, I'm just thinking, and I'm curious to have your opinions on, well, all this risks. Of course, there is an education angle, and I think eventually there'll be even some version of insurance angle from specific risks, like you have for slashing. Maybe you will have one day an Oracle related insurance you can get that can put you at ease, and the premium can be low only if there are some risk assessment from trusted provider of the insurance that set a standard on what is dangerous or not. But at the end of the day, right now, the one that will understand the most risk, and well, there are some big Oracle that are not there and they have different views, etc. But at the end of the day, it's really the participant, the one like being exposed to the attacks, that they understand the risk more than anybody else. So I'll send a question to you: is what do you think is needed to create something that would help bring visibility on the Oracle risks? And I think they're really varied and broad, and might be have to be divided into categories. But what do you think is not there yet that would help you, have institutional DeFi in a safer way?
So maybe I can touch first, because then I'm going to lean to you. This is, I think, a really interesting question. Like, the Oracle can be as transparent as it possibly can. It can put all these, everything out there. It can like strive to be as transparent as possible. But at the end of the day, it's like, it's what you've said. It's like, okay, this is my API essentially. Are you trusting this or not? And so then what we think and what we turn to is like, then should there be external third parties that are evaluating the risk of the Oracle? It's in the best interest of the Oracle to be as transparent as possible, but this is still like a unique, singular point of risk that then you're deferring to them on trusting this transparency is correct and accurate. So then we turn to the risk curators, right? And we take a look at how are teams like Chaos Labs looking at this in terms of like evaluating Oracle risk from a third party perspective.
So it's not like really third party for us, because we launched our Oracle around 18 months ago. So we do it as well for some of the protocols that we work with, but obviously all of this is baked into our methodology. I think the things that you've said already, they help, right? Maybe insurance, maybe ratings, all of these are important. I think like as a user, as a protocol, as an institutional investor, the single thing which gives or should give the most confidence and carry the most weight, similar actually to a risk manager or fund manager, is track record, right? So that's number one, right? You need to look at the track record of all of these like Oracle providers. There's a difference between what people market and say and actually, what's happened in production. That's number one. Number two is defense in depth. There is no perfect Oracle solution that you can rely on, right? So how do you mitigate that risk? There are some risks that you can address on the smart contract level, deviation checks, kill switches. There are others that you can by having consensus around qualified data sources. The qualified here is really important. It all depends on the use case. But I think like in terms of the most peace of mind, at the end of the day, everything here is auxiliary. It helps them get comfortable. These standards should exist. We should have ratings, but it's the track record and it's the defense in depth which really matter when these tail events occur. I'll just say like, how many times have we seen things that are highly rated or considered in the industry kind of go down when it matters most? I think today, Cloudflare, we had one this morning, right? The whole internet is down and when you think of reliability, you think of that. The difference is we're dealing with value. So the margin for error is much smaller. It's not that your website won't load, it's that the trade won't go through or that you incorrectly got liquidated.
And again, I think the whole events over the last 3-4 weeks really does kind of beg the presence of more insurance. Like I completely agree with this. Maybe it should be the insurance providers that are underwriting the risk of all different levers of the DeFi stack, not just the Oracle, but again, like the RPCs, the down to the protocol level security, even down to the network that a protocol exists on. Like I think that this should be all underwritten by third parties. And then one thing we haven't even discussed is like Oracle redundancy. Is like the leveraging multiple different oracles as sources of price or truth within a given one singular protocol. I think that this is also a great way to remove your dependencies on a singular point of risk.
This was a really, really great conversation. I really like hearing everybody's takes on it. I know we are out of time, so I want to take the last few seconds, like anybody that's following online or wanted to follow up more with what you guys are talking about, tell us how we can follow you, find out more information about what you're working on. So go ahead and just throw it out from the corner until we get to the end, and then we'll finish it off with that.
Sure. The easiest way is probably to find me on LinkedIn with my name. I don't have a very strong presence. I don't do a lot of debate on X. So yeah, if you got a question related to rating index, risk in general, you can ping me there.
All right, yeah, for us, so everything related to risk ratings, tokenized assets, vaults, structured yield index, risk passport, etc. We do distribute very frequently information on our company account on X and LinkedIn. And definitely if you want to get, because we also curate like a Telegram channel for institutional investors, for institutional players, all about tokenized assets, oracles, etc. If you want to get in, just drop me a message on X or LinkedIn, and then I will get you invited.
You should add me to that.
I did, I think.
For us, you could find us on X at Dia Oracles, myself, Dillon Hanson 12, and diadata.org for the website.
On X, it's Chaos Labs, just one word. And for me, it's Omer A. Goldberg. I'm responsive, so feel free to reach out via DMs.
And I am Billy. You can reach out if you want to find out more about Katana Network. You can follow at Katana Network. And if you want to talk DeFi stuff and nerd strategies, I'm your guy. And thank you guys so much for checking us in. Thank you guys for the panel. Really interesting conversation. I know I kind of nerd out sometimes on this stuff, so really good stuff to go back and like check this out. Thank you guys.
Yeah. Thanks.
Thanks.